Welcome back, everyone. Next, we have Battery Mineral Resources Corp. It trades on the OTCQB under the symbol BTRMF and on the TSXV under the symbol BMR. It's a battery minerals company providing shareholders exposure to the global megatrend of electrification while being focused on growth through cash flow, exploration, and acquisitions in favorable mining jurisdictions. Please welcome President and CEO Martin Kostuik. Nice to see you, Martin. Welcome.
No, thank you very much. Very excited to be a part of the conference today.
Okay, great. Well, the floor is yours, and when you're ready for questions, call me back.
Absolutely. That sounds great. Well, I want to introduce myself. I'm Martin Kostuik. I'm the CEO of Battery Mineral Resources. Battery is a relatively new company to the public markets. We've been public now for a couple of years, and it is our goal to provide our shareholders with exposure to this global electrification trend that I think we're all very well aware of. Not just the advent of increasing electrification around the world as countries strive to have more electricity and access to electricity, but also I think maybe one of the larger impacts is this trend going towards electric cars and other vehicles. So it is our goal to provide our shareholders with exposure to this marketplace via the commodities that our company represents, and I'll get into that. And it's not just the exposure. So you wonder why is exposure a great thing? Well, we believe that we're going to provide value via that exposure because we are going to transform our company from where we are now, which is a development style company, and very soon we're going to be entering into cash flowing within Battery Mineral Resources. We believe that is the best way to provide value to our shareholders. So having said that, and by the way, I'm just going through our corporate presentation, which is available on our website. So you can reference that as well. And I believe the conference will be sending you a copy after this. So having said that, I'm going to be skipping around a few slides. But I did say that we're going to be entering into cash flow. And I just want to take 1 minute here to explain that we actually already in cash flow. We have a 100% wholly owned subsidiary that is a part of Battery Mineral Resources, which, by the way, has anything to do with really the mining industry. But during the process of becoming a public company, our largest shareholder, a private equity firm based out of New York, had the vision that while Battery Mineral Resources was transforming itself and while it was developing its projects, it would have need for cash. So they had the idea that putting one of their other portfolio companies into our company during the process of becoming public would be a good idea because this company here, Energy Services Inc., ESI, also known as Aussies, does have the ability to provide us cash, which takes a burden away from the shareholders in terms of us having to go to the shareholders to raise equity. So it's a great company to have in our portfolio, generating around $3 to $4 to $5 million in EBITDA per year. And just a brief note on what the company does. If you look at the picture on the top right, that picture essentially explains what the company does. They produce and either sell or lease pipeline padding equipment to contractors. Over the years, ESI has been able to expand its marketplace from pipeline to also renewable energy because they work with contractors that are installing solar farms and wind farms as well. But essentially, when a contractor has the requirement to bury a utility, it could be an oil or gas pipeline, it could be an electric line, it could be fiber optics, anything that needs to be buried on these job sites, they have to excavate a ditch, lay the material in there, lay the utility in there, and then cover it back up with padding material. Typically, without this use of equipment, the contractor would have to source fresh material from a local quarry or whatnot. But by using the equipment that Aussies produces, it allows them to reuse the material that they excavated to create the ditch. So it's a very efficient thing for them to have, and it's a very popular item for them to lease. They've been in business for over 30 years. So enough on that, but that just wanted to clarify that I wasn't completely telling the truth when I said that we're entering into cash flow because we actually are in a small way. But having said that, our focus is, again, providing exposure for our shareholders to this electrification trend via the commodities that we represent. As you can see on this slide, we represent cobalt in northern Ontario, cobalt in northern Idaho, graphite in South Korea, We have a very early stage lithium brine project in Nevada. And I think the main crux of our thesis here is we are going to be using this brand new copper asset that we acquired about 2 years ago to be the primary method of us going into cash flow. So let me explain. So it is job one for us in order to enter into cash flow is to get the mine going again. And this mine is called the Punataki mine. It is a former producing underground copper mine that has about a 10-year operating history. And I'll talk more about that in a second. It is job one to get Punataki operating again, getting into cash flowing. And then we can look at these other projects that I briefly introduced to you. We can then treat them as a pipeline of projects, because right now, without the ability, other than going to shareholders, without the ability to fund their development, I can't really call them a pipeline. But once we're into cash flowing, generating cash and profits at Punataki, then we can treat those as a pipeline of projects. And that's exactly what we intend on doing. And we'll talk more about those projects near the end of the presentation. But as an aside, since we've been going down to Chile after we acquired the assets of this project, the second box really relates to our confidence that we have many, many opportunities to repeat what we are about to do at the Punataki mine with several other excellent opportunities in Chile. So even before perhaps that we start developing and some of these other projects, we think we have many opportunities to scale the company in Chile itself. And we can talk more about that in the Q&A perhaps. But let's talk about the Punataki mine. Again, it's a former producing underground copper mine with about a 10-year operating history. In the very early days, Glencore acquired the project, finished allocating capital to it, and operated it for about 8.5 years. This was Glencore's very first copper mine in Chile. And we were able to acquire the assets, not from Glencore, though. Glencore, of course, shortly after they acquired the mine, they became a much larger company. And the production profile of this mine became non-core for them. So they, which is very typical when companies grow, they found a suitor in our predecessor, which was another junior mining company. They sold this mine to our predecessor while it was operating in November of 2018. And the operator at that time enjoyed a couple of good months and was having a good run at operating the mine. But unfortunately for them, they almost immediately found themselves in a steeply declining copper market. The mine shut down in April of 2020, really due to lack of cash. And at that time, copper was around $2. Of course, that's when COVID hit, and that was probably the last straw for them. They put up the white flag, and we were able to come in and buy the assets of this mine via renegotiating debt with the unsecured creditors at that time. So it took about a year, and we've eventually purchased the assets of the mine, and I'll get into more of that transaction in a minute. The Punataki mine, as you can see from the map on the right, is about an hour's drive from the coast. So it is not way up in the Andes Mountains with no infrastructure, no power, no roads, no water. In fact, and it's in a very industrial area and very agricultural area. So there's plenty of water, existing power, roads. We have access to equipment suppliers, contractors, all kinds of support. And more importantly, we have the support of the community around us, and we have plenty of population to become our workers. As you recall, the mine was operating for almost 10 years. So we have quite a good reputation in the area, and looking to always increase and improve on that reputation as we work with the communities. So we have essentially all of the fixed assets that you would expect that a former producing underground copper mine should have. We have every one of them, and that is really the thesis of our investment, is that we came into this looking for opportunities to turn the company into a cash flowing entity, and we fully believe that the resumption of operations, the investment that it takes to resume operations at Punataki is the right thing for our shareholders. And really, there's some very basic reasons for that. Really, the low price point that we came in and bought the assets, around $12 million US, because of the sunk capital that Glencore put into it and other people, and the operating history, we are looking at a very modest cost to bring the mine back into production, it's around between $12 and $15 million to put the mine into cash flowing again. And because, again, of the sunk capital and the existing assets there, all of that means a very short time frame from first investment until the mine starts producing copper again, a very short time frame of 4 to 5 months. So historically, the mine, for those years that it operated, it produced anywhere from 20 to 25 million pounds of copper. And looking at the historical cash profile, the cash cost profile, and our own internal projections, we believe that those are about the same. And at a $4 copper price, using $4 as an example, we will be producing anywhere from around $1.55 cash margin for every pound of copper that we produce. All of that means that depending on copper price and the current production profile, we could be producing anywhere from 30 to 50 million in EBITDA. So having said that, a very modest investment to enter into that level of cash flow, we believe is a great investment for the company and the shareholders. So we've been busy down in Chile, which, by the way, we believe is just an excellent operating environment. Copper is number one in Chile for a reason, and we believe it's going to stay that way for a long time. But as soon as almost immediately after acquiring the assets of this project, we managed to bring some money together with the help of ESI as well, and we started a drill program down there in August of 2021. We started drilling. As you can imagine, we felt it was necessary to start drilling to accomplish a few things. First of all, when we had a look at what we really had, we realized that the resources down there were quite minimal. And you can imagine our prior predecessor was operating it with a decreasing amount of revenue coming in because of decreasing copper prices. So they didn't explore, and they mined what they could to try and stay alive. Now, for us, we came in with less than 500,000 tons in resource. And to put that in perspective, the mine consumes about 1 million tons of resources a year when it's at full production. So less than 500,000 in our resources. We began a very good drilling program, very aggressive drilling program. By the end of the program, August of last year, we ended up with more than 6 million tons in indicated and inferred, in indicated and 3 million tons in inferred. So altogether, a very nice resource package, starting with less than 500,000. So what that did for us is it gave us confidence that in a fairly short amount of time, we have the ability to add resources. We understand the geology. It gives us confidence that we can continue adding resources in the future. Of course, adding resources is part of our sustaining capital plan in our operating plan. And I think more importantly, it allowed us to have a nice runway of operating tons in front of us. And that was the final criteria that we needed in order to decide to make an investment in turning this mine into a producing asset again. So moving along the timeline, we did a lot of work in terms of turning resources into reserves and creating mine plans and economic models. And all of that is part of the work to prepare to invest in this mine. Now, the timeline shows that we are striving to bring the capital in that's required to restart the mine during this quarter. And if we're successful in doing that, and because of the sunk capital and the money that was invested in the mine, as I explained earlier, we are looking at getting into cash flowing again via the production of copper within 3 to 4 months, 4 to 5 months, somewhere in that range, and have a great chance of becoming a cash flowing entity at the end of Q1 or early Q2 next year. So it could happen very quickly. And the reason why is again, because we have a very simple capital allocation plan. It's not a tremendous amount of money that we have to spend there. And because it was a recently operating asset. So that's really the reason. And it gives us a lot of confidence. It takes a lot of risk out of the investment. What we're looking for right now is we have a 3-part plan to raise the capital. I said that the capital to put the mine back into production is between 12 and 15 million. We're actually looking to raise 17, which brings in a little bit of contingency for us and allows some capital to be allocated to our other projects to maintain them. So really we're looking at a combination of a convertible debenture and 2 pieces of potential debt, one against cash flows of VSI and one against our assets. So all this is a very sort of simple way, I believe, to bring together the capital in a non-dilutive manner. And we believe that this is, again, the right choice for our investors, and because of the returns that we're looking at entering into. So we're very excited to be able to present that thesis. It's not finished. We're in the middle of things, if you've read our press releases, and it's going very, very well, I must say. So a little bit more on Punitaki. If you look at the map on the right-hand side, you can see there's a reference to these gold boxes. All of those gold boxes are the deposits that will be feeding the mill in terms of underground mining to feed the mill, which is located almost directly in between all of those gold boxes you can see. Sanabria was the original mine that fed the mill for the 10 years that the mine operated. We ourselves, via our drill programs, have brought in several new deposits that we'll be putting into production. To the north of Sanabria is a deposit called Sanabria Norte. That's a brand new discovery that we made during our drill program. Over to the left which is only about 300 meters away, is a deposit called San Andres. And then all the way to the bottom of the screen is another brand new deposit called Dalmatia. So we're very excited to not only have the success of the drill program, but being able to bring these deposits in an economic manner and making them part of the plan to bring in cash to the company. A little bit, I spoke briefly about the resources earlier, and this is some references that you can see in terms of the total for measured and indicated and also inferred. So you can see some of the names that I referenced in the previous slide in terms of the allocation of resources in each one of those deposits. So I think the final word on Punitaki is that it's not just the opportunity that we have on our deposits that we've discovered. We have many, many more exploration targets on our claims. We have a very large land package within this 25-kilometer trend. But as you can see from the map, it's a very busy area. There's several other operating mines that we're developing synergies with, and perhaps could present us commercial opportunities in the future. So it's a very busy area. We're very happy to be there and using Punitaki as a platform to scale the company. So I'll just go briefly on our other assets that I very, very briefly introduced at the beginning of the presentation. These are some pictures of historic mining in the Cobalt, Ontario area. Those are not recent pictures, of course. But just to show that there is a tremendous amount of opportunity in Northern Ontario in the cobalt industry. Many, many pounds of cobalt had been produced in there over the years, and hence the name of the town that we're close to, called Cobalt, Ontario. So we have a feather in our cap. We have the only brand new resource of cobalt that's been found in many, many years via the efforts of our past exploration programs there. So lots of opportunity. Lots of opportunity in Northern Idaho. Switching pages here, Northern Idaho is another historic cobalt producing region. We're very excited about our prospects here because the ground is quite valuable there. The resources that are in the area, the former producing mines, all enjoyed the ability to produce not only cobalt, but also copper and gold. So quite valuable rock. Our property is contiguous to a property that's being put into production by a company called Jervois. So we're excited about the prospects there. It is a drill-ready property, so a modest investment to start realizing some returns there, in my opinion. We have 2 former producing graphite mines in South Korea. Now, these are excellent properties that are just ripe for a small investment to increase the exploration and increase the resources that we have. We have official resources on one of the properties. And you may or may not know that China has recently announced that they're going to restrict the amount of graphite that's exported from the country. And you may also know that China represents more than 80% of the supply of graphite to the world. So there is going to be a lot of attention being put on graphite deposits and potential producing areas outside of China. So we feel like we're in a very good position here. So having said that, we believe that giving our shareholders exposure to this global electrification trend via the commodities we represent, but not just exposure, but an actual plan to bring value, which is transforming the company into a cash flowing entity, is exactly what our shareholders would be interested in. And we have many catalysts in front of us in terms of bringing the capital in, restarting the mine, and all of this, we believe, will bring incredible value for us and our shareholders. So with that, I'd like to open up the platform for questions, and I look forward to speaking with you.
Great job, Martin. Thank you for your presentation. We do have some questions for you. Let's start off, talk a little bit about some of your goals specifically to add shareholder value. That's
a great question. You know, I think our goals really come back to our overall strategy in terms of not only giving exposure. That's one thing, and that's a great start, giving people exposure to this trend via the commodities we represent. But what do you do with that exposure? Why does that mean anything? I think it means something because via the commodities that we represent, we plan on transforming the company into a cash flowing entity, and we believe that you know, it's going to be a rare commodity that a company is entering into copper production in this coming year. And that in itself and the ability for us to generate cash from this operation is going to bring great value to the shareholders.
Perfect. And speaking of value to shareholders, talk a little bit about how restarting Punataki will add value for them.
Yeah, I think we can think about it in a couple of ways. You know, we look at the initial purchase of the assets, and this is a clean purchase. We are not dealing with Glencore or the prior operator. We simply acquired the assets of this operation, and so we have the ability to bring this into operation with a modest investment after the modest purchase price. And so the low amount of capital required to not only acquire it but to put it back into production, and the short time frame it's going to take to put it back into production, all these things for us mean low risk, and for our shareholders mean lower risk, to enter into a nice, strong cash flowing business of anywhere from 30 to 50 million in EBITDA.
Perfect. Speaking of EBITDA, talk a little bit more about some of your financials, specifically funding situation, maybe some strategies.
Yeah, that's great, and that's a very pertinent question. We're sitting on a decent amount of cash right now. We'd like to keep plenty in the treasury to have runway for our very busy. We're very busy corporately, and we're very busy down in Chile. So we have a nice amount of cash. We're in the middle of bringing more funds in. These funds are almost 100% being allocated towards restarting activities at the mine. And we have a very busy, I just returned from Chile last week. I'm there once a month. We have a very active site with a very strong general manager, a very strong country manager. They're building a team right now, and we're allocating capital to execute the various projects we need to do in order to get the mine producing again. So with the money coming in and this three-part plan that you see in front of you, we believe we're going to be successful. And once we start producing copper, then I think sky's the limit for the company in terms of scaling and bringing in value to the shareholders.
Hal Bullock would like you to talk a little bit more about your copper supply and your copper demand. Are you also involved in other metals?
Yes, we have a view, and I think there's a general consensus that copper is going to be in short supply in the latter part of 2024 and certainly into 25 and 26. This trend of electrification is outpacing the supply of copper, due largely, and I think it's very, very clear to most people that look at this subject, that due largely to the lack of investment in new mines over the last 10 to 15 years. Companies have been focusing on buying back their shares and making their operations more efficient, but haven't been investing in bringing in new mines into production. So it's going to take a while for the industry to turn around and bring in new production. So of course this will mean shorter supply and higher prices for copper. And so it's I think that's a very obvious thing for most people. But we do represent other metals, and the other metals we represent are largely to do with battery minerals. As you can see from our slide here, we represent cobalt in 2 different jurisdictions. We represent graphite in South Korea, and we have a very early stage lithium brine project in the U.S. It's in the same basin as the only operating lithium mine in the country. So we feel very excited that that we're involved with these commodities because every one of them are projected to be in short supply in the coming years.
And Richard Hankey wants you to clarify how many shares are in your float. And as far as your capital raise goes, are you focused on investors or relying more on debt?
We are right. Our current capital structure is such that we have about 170 million shares out there. We don't have any warrants in that share structure. And so it's a fairly tight, share structure. We are looking at the way that we're financing this is we always keep an eye towards trying to minimize dilution. And this is why we're bringing in some debt along with the other component is a convertible debenture. So it allows us to not only bring in the capital that's required, but keep dilution to a minimum. So as you can see here, we have a sort of a 3-part plan. One part is a convertible debenture, and then the two other legs of this stool would be pieces of debt. Now, we're obviously mindful not to bring in too much debt, but we think this is a reasonable amount that we can certainly service in the coming years.
And Gil asks, are there other subsidiaries that you control that are not yet throwing off cash?
We don't have any other subsidiaries. We just have the one, which I believe is very unique. It's a great question because do we have any other things in the closet there? But no, ESI is the only operating subsidiary that we control, other than the assets that we control virtually around the world. That is the complete picture of BMR.
And Cameron asks about ESI. Is that the subsidiary wholly owned? And what is their growth rate anticipated?
I'm sorry, can you repeat that?
Is the subsidiary wholly owned, the ESI that you mentioned? And can you talk about the growth rate?
Yeah, no, I can. Sorry, I was reading some notes here. The ESI is 100% wholly owned subsidiary. We completed the acquisition of that shortly after our process of becoming public, and ESI is doing very well. It's got a very long operating history, a great customer base, and they're doing a great job of transforming themselves to be open to servicing the renewable energy space, not just the oil and gas pipeline space. So that diversification has boded very well for them. As you may or may not know, the pipeline business in the U.S. is decreasing as people turn away from oil and gas. So they've done a great job of transforming themselves and being able to service the renewable space quite well. They're also investing a fair bit of capital into their own business, and that capital is projected to create great returns for them in terms of increasing revenue going into the future. And it's really allocating capital to producing new products that they're offering to the marketplace. And we're just starting to see the returns on those investments now. So they have a very bright future in front of them in terms of increasing revenue in the future.
And Steve Padilla asks if you'll be looking into acquiring manganese resources.
I've not run into any opportunities for that, but we are obviously a multi-commodity company, and we would be open to any investment that would be accretive to our shareholders.
Just a few questions about Punitaki. Mike Booth asks, with Punitaki, would you consider Battery Mineral Resources beyond exploration and a producing company?
Absolutely. Punitaki is the advent of resuming operations at Punataki is going to transform the company into a cash flowing entity. And it in itself, without even turning around and investing in the other existing commodities that we represent, that in itself is a transformational thing. And I say transformational because it's not just bringing cash in, but it's utilizing the new value that Punataki is going to bring to the company as leverage and as marketability to scale the company, to use the newfound value to scale the company. And that's really the purpose of bringing Punataki into production.
And Trey Lawson wants you to clarify, Punataki mine was transferred in 11/18, shut down in 2020. You said $15 million to get it into production. Can you clarify that, as well as explain your plan to obtain the capital and the timeline to production?
Okay. Yes. So Punataki is requiring around, it's actually a little less than $15 million, but we're raising $17 million. And let me get to that slide so you can look at it while I'm talking. We're raising $17 million because we have costs with our other properties, and we want to add some contingencies in there. That is the total funding goal right now, and we're well along our way to getting there. The actual cost of Punataki, putting it back into production, is quite modest because of the sunk capital there. Its recent operating history, as he just referenced, it was shut down in April of 2020. So we're very excited that it's sort of a simple capital allocation for us. Now the timeline is really illustrated here. We believe, and of course we've got very detailed plans that we've been executing for many months now. We're taking let me back up. We are taking the view that this is not an exercise. We are investing for the very strict purpose of putting this mine back into production. So we're treating it very seriously. We have very detailed plans. We have all the operating history. We have several of our current employees worked at the former operating mine. So we have a lot of experience here as well. And with these plans, it produces this timeline you're seeing here. We believe through all of our planning that if we are able to bring in the capital that we require in this quarter, which this timeline shows, that we'll be back into cash flowing. We'll allocate the capital over the next 4 months and be into cash flowing in either late Q1 or early Q2 next year. So that's really the timeline. Then it's ramping up to full operations after that, continuing to explore and looking at other opportunities around Chile. That's Perfect. Really fun. Yeah.
Well, Martin, thank you so much for this great presentation, and we would love to have you on in the future with some updates. Thank you for your time today.
I look forward to it, and thank you, everybody, for those great questions.
Okay, we'll see you again soon. Thank you so much for joining us.
Thank you.
Okay, everyone, stay with us. We'll be right back with our next